Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
Yeah, we are back in the studio and ready to get to work on this one.
Today, we're breaking down one of the most interesting and, frankly, analytically perplexing companies in the market right now.
Well, absolutely. It's a puzzle.
We are looking at Vanda Pharmaceuticals, Inc., ticker symbol VNDA.
Right.
And this isn't your typical tech high flyer or, some steady dividend payer. We are looking at a fascinating case study in the small cap biopharma space.
Which is an incredibly volatile sector to begin with.
Exactly. Specifically, we're examining a company dealing with the brutal life cycle of drug patents and the high-stakes game of commercialization.
And it is high stakes. It's a capital-intensive game.
On the surface, the setup here is, well, it's incredibly seductive. It looks like a classic Benjamin Graham value play.
The math looks almost too good on paper.
It does. The stock looks incredibly cheap, trading very close to the actual value of the cold, hard cash it holds in the bank.
Right. You look at the balance sheet, you look at the stock price, and you think, wait, am I getting the actual business for free?
Yeah. But here is the billion-dollar question for us, and the reason we are, turning the lights on this specific stock today.
The real tension here.
Is this a genuine bargain where we are getting a drug pipeline for effectively zero cost, or are we looking at a classic value trap?
A melting ice cube.
Exactly, a melting ice cube where management will incinerate that massive cash pile before they ever reach profitability. That is what we are here to find out.
That's a huge topic. And it's one of the most dangerous setups for investors because the math looks so safe when it might actually be a siren song.
It really might be.
But before we dive deep into those numbers, a quick heads up for the audience.
Right. If you're looking to invest, whether it's in biopharma or broader markets, we use Interactive Brokers.
It's the platform we rely on for execution and the deep data we need.
Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time. We really appreciate you using those links. It keeps the lights on here at Synaptic.
And while you're down there, please like, subscribe, and let us know your questions in the comments.
We read them all. We love the debate, so definitely get involved in the community down there.
Okay.
Now let's get into it. Pillar number 1, the business model. We need to start with the engine itself.
Let's start by cracking open the black box of Vanda Pharmaceuticals. Because if you just look at the ticker, it's just letters on a screen. We have to understand how they actually make a dollar.
And how they lose dollars, frankly.
Yeah. Right. Fundamentally, this is a biopharmaceutical company. Their entire existence is predicated on three things: discovering, developing, and crucially commercializing products to treat specific medical conditions.
That commercialization piece is where most of these small caps stumble.
They aren't just a research lab in a basement somewhere. They are trying to sell physical pills to actual patients. But unlike a massive conglomerate, say a Pfizer or a Merck,
They don't have infinite resources.
right, they are working with a very concentrated portfolio.
Concentrated is the polite word for it. In this industry, concentration is pure risk.
Yeah.
You don't have 50 other drugs to fall back on if one fails clinical trials or loses patent protection.
Exactly. When we look at their specific portfolio, it's a mix of the old guard and the new hope.
The legacy cash cows and the pipeline.
Yeah, on the legacy side, the drugs that have been paying the bills historically, we have Fanapt,
Right.
which is used for the treatment of schizophrenia and bipolar I disorder. And then you have Hetlios, which targets sleep-wake disorders.
Specifically non-24-hour sleep-wake disorder, which is a very niche indication.
Right, those are the names you'll see driving the historical financials if you pull up a 10K from a few years ago.
And it's worth pausing on what these legacy drugs actually do, because the mechanism of action matters deeply for the business moat.
Break that down for us.
So Fanapt is an atypical antipsychotic, and it competes in an incredibly crowded space.
The psychiatric medication market is packed.
Fully packed. You have generic risperidone, olanzapine, clozapine. These are drugs that have been around for decades.
And they cost pennies a day.
Literally pennies. So for a doctor to prescribe Fanapt, they have to believe it offers a very specific nuance or side effect profile that the generics just don't have.
It's a Me Too drug in many ways.
Exactly. It's fighting for market share in a highly commoditized therapeutic area. It's an uphill battle every single day for their sales reps.
And then we have the pipeline, the stuff that the bulls are pounding the table about.
The new narrative.
Yeah, we have Ponvery, and then we have the newly approved assets, Nurix, which is indicated for motion sickness.
Which we will definitely talk about.
We will. And Basanti. So you have this mix of established psychiatric treatments and some totally new ventures into things like motion sickness.
Okay, so we have the products on the table, but the most important question in this sector, and I stress this to everyone looking at biopharma, is the revenue model. Who actually pays for this?
Because it's not the patient. Not really.
No, the patient walks into the pharmacy, picks up the bottle, and maybe pays a $10 copay. But that's not where the money comes from. And this is where most generalist investors just completely get lost.
It's the classic U.S. healthcare maze.
It is a labyrinth.
The primary payers are health insurers and pharmacy benefit managers, or PBMs. Now, the revenue model is technically recurring. These are treatments for chronic conditions like schizophrenia.
You don't take it once and you're cured.
Right. You take it potentially for a lifetime. That's good for business predictability, theoretically.
In theory, yes.
However, I really want to push on this concept of the gross-to-net rebate pressure because we hear this term thrown around in earnings calls all the time. Management loves to blame it. Walk us through the mechanics. Why does a company like Vanda lose so much money between the list price and what actually hits their bank account?
This is the single most critical structural headwind for small-cap biopharma. We have to talk about the PBM oligopoly.
The gatekeepers.
The ultimate gatekeepers. In the United States, 3 major companies, CVS Caremark, Express Scripts, and Optum Control, roughly 80% of the prescription drug market.
80%. That is massive concentration of power.
It's a bottleneck. If you want your drug, say Fanapt, to be covered by insurance so a patient can actually afford it, you have to be on their formulary.
Which is essentially the menu of approved drugs that the insurance will actually pay for.
Right. And getting on that menu isn't free.
Far from it.
These PBMs operate like a toll booth, but with a very heavy gate. Because Fanapt has generic competitors, the PBM goes to Vanda and says, look, we can just tell everyone to use generic risperidone. It costs us nothing.
Give us a reason to put you on the menu.
Exactly. If you want us to cover Fanapt, you need to pay us a rebate. And this isn't a 5% discount we're talking about here.
Right. This is the growth to net bubble.
Vanda might set the list price at, let's say, $1,000 to look good on paper, but the PBM might demand a 40, 50, or even 60% rebate just to secure that formulary spot.
So for every dollar of sales they report in that top gross line, they might only be seeing 40 or 50 cents in actual cash.
Exactly. And the underlying problem is scale. Pfizer has leverage. They can bundle a dozen blockbuster drugs together and negotiate.
They can play hardball.
Vanda has zero leverage. They are pure price takers in this dynamic. So the gross sales might look huge, but the net sales, what actually hits Vanda's bank account to pay salaries and fund research, is significantly lower.
It's a recurring revenue model, yes, but it's one where you are constantly fighting a war to keep your margins from being eaten alive by the middlemen.
This structural tax explains why their top-line growth often just doesn't translate to the bottom line efficiently at all.
Okay, so we have a business selling chronic medication in a high-pressure rebate environment. Let's apply the framework we always use here. Let's talk about the Moat.
The Hamilton-Helmer framework.
Yeah. Where does Vanda sit in that framework?
Well, if you look for a moat here, you really only find one viable candidate. It's the cornered resource.
The intellectual property.
Exactly. In the biopharma world, that resource is the patents and the regulatory exclusivity granted by the FDA. When the FDA approves a drug like Nurix, Vanda gets a monopoly.
A legal monopoly.
Legally, no one else can copy that exact molecule and sell it for a set period. That is an incredibly powerful government-sanctioned moat.
On paper, that sounds fantastic. A legal monopoly is the dream of any capitalist. But I have to challenge that a bit. Patents don't last forever.
No, they don't.
So isn't this moat incredibly fragile? It feels less like a stone fortress and more like a sandcastle when the tide is coming in.
That is the anti-moat reality. You nailed it. This isn't a network effect like a social media company where it gets stronger and stronger as it gets bigger.
Right, Facebook gets better the more people use it.
This is a business engine that is fighting a war against time. It's a literal ticking clock. Every single day that passes, the patent gets one day closer to expiration.
The value of the asset degrades daily.
And we aren't just speculating about this risk for Vanda. We have a live body to examine right now. Look at Hetlios.
The sleep disorder drug.
Exactly. Hetlios is already facing what we call generic erosion. The patent walls have been breached.
The generics are flooding in.
Competitors are coming in with generic versions of the molecule. And the impact is immediate, and it is brutal. In the fourth quarter of 2025 alone, sales for Hetlios dropped by 18% year over year.
18%. That's a massive contraction for a single quarter.
It highlights the binary nature of this industry. When a generic hits, it doesn't just politely take 10% of the market over 5 years. It destroys the pricing structure overnight.
Because the generic might be 90% cheaper.
Easily. And the insurers immediately force patients to switch. It proves that the business engine isn't dynamic. It can't just pivot to a new feature like a software company.
Once the patent expires, the moat doesn't just shrink, it evaporates instantly.
The moment a generic hits the pharmacy shelf, the price collapses, and the volume shifts to the cheaper option. It's ruthless.
Let's stress test this idea of business quality a bit further. Because the ultimate signal of a high-quality business, arguably the only one that truly matters in the long run, is pricing power.
Warren Buffett's favorite metric.
Exactly. Can you raise prices without losing your customers? What does the evidence say about Vanda's pricing power? Because I was looking at the Fanapt numbers for fiscal year 2025, and there was a very weird discrepancy.
You saw the divergence between volume and value.
I did. The headline number looks great. Net product sales for Fanapt increased by 24%.
Which sounds amazing.
If you stop reading the earnings release right there, you think, wow, what a growth engine. But you have to look under the hood. That revenue growth was driven by a 28% rise in total prescriptions.
Let's do the math there for a second. Prescriptions, the physical volume of pills moving out the door went up 28%, but the revenue only went up 24%.
Volume grew faster than revenue.
That implies a negative price mix. It means that on a per-unit basis, they're getting paid less than they were the year before.
Exactly. It indicates either a negative price mix or, much more likely, even heavier rebating to those PBMs we talked about earlier.
They had to bribe the toll booth operator even more.
To move those extra units, to get those extra prescriptions written and approved, Vanda had to give up margin. They effectively had to discount the product.
Which is the opposite of pricing power?
True pricing power, the kind we see in elite compounders, means revenue grows faster than volume because you're raising prices on top of selling more units. Vanda is doing the exact opposite. They are giving up pricing to chase volume. That is not the signature of an elite business.
That's a critical distinction. It suggests they are buying their growth, in a sense. Let's talk about the consumer side of that, though. Is there any brand loyalty? I mean, do patients demand Vanda brand drugs from their doctors?
This is where we talk about soft power and switching costs. In the consumer tech world, you might stick with an iPhone because switching all your data to Android is annoying. That's a real switching cost. In psychiatric meds, specifically for bipolar and schizophrenia, there is an illusion of switching costs.
Because you might think a patient wouldn't want to change a brain medication that finally works for them.
Theoretically, yes. Mental health stability is incredibly fragile. You'd think they'd be terrified to switch.
But practically?
Practically, adherence in these specific demographics is notoriously low to begin with. But the real killer is the generic threat we just discussed. Once a generic hits the market, the patient often doesn't even have a choice in the matter.
The insurer, the one actually paying the bill, forces the switch.
They send a letter saying, we will cover the generic for $10 or you can pay $1,000 out of pocket for the brand name.
And at that point, any semblance of brand loyalty hits a brick wall of a 90% price difference.
Exactly. There is no consumer brand loyalty strong enough to override a $900 difference at the pharmacy counter. The stickiness vanishes the moment the economic incentive shifts for the insurer.
So the idea that Vanda somehow owns the customer relationship is a fallacy.
A complete fallacy. The insurer owns it, and the insurer always wants the cheapest option.
That's a sobering look at the business engine. It's a leaky bucket where you have to constantly pour in expensive new drugs just to replace the ones draining out the bottom from patent cliffs.
Leaky bucket is the perfect analogy here, and that leads us directly into the financial consequences of running a leaky bucket.
The numbers.
If the moat is leaking revenue, as we just established, that has to show up in the bank account eventually. Does the balance sheet bleed as badly as the patent portfolio?
This is where we shift to financial resilience, or, as I like to call it, the quality of earnings test.
My favorite part.
We've looked at the qualitative narrative side. Now let's look at the hard numbers. And looking at this data, frankly, they are ugly.
Ugly might be polite. We are witnessing what I would confidently call a profitability collapse.
Let's look at the margins.
The trajectory is terrifying. In 2024, operating margins were already negative, sitting at negative 20.5%. That's bad enough. But fast forward to late 2025, and those margins have collapsed to a staggering negative 70.5%.
That is a breathtaking drop. A negative 70% margin means for every single dollar of revenue they bring in, they're spending $1.70 to get it.
It's unsustainable physics.
How do you even get to negative 70%?
It's a combination of two things. First, operationally, they have escalating commercialization costs.
Right, launching drugs is not cheap.
It costs an absolute fortune to launch new drugs like Ponvory and Nereus. You need armies of sales reps, massive marketing campaigns, medical conferences. But the big hit, the thing that really tanked that margin, was a massive one-time item.
The tax allowance.
Yes, a $113.7 million tax valuation allowance.
Okay, we need to stop and really unpack that, because tax valuation allowance sounds like incredibly boring accounting jargon.
Yeah.
Your eyes glaze over when you read it in a 10K.
But it is a screaming siren from the finance department.
It tells a very specific, very dark story about the future of the company.
Break down how that works for us.
Here's how it works mechanically. When a company loses money, which Vanda does, they accumulate tax assets. These are basically credits they can use to lower their taxes in the future when they eventually make a profit.
That's like a coupon for future tax breaks.
Exactly. A coupon. These sit on the balance sheet as an asset called a deferred tax asset.
Because it theoretically has value if you make money later to apply it against.
That keyword.
Yeah.
If accounting rules state that you can only keep that asset on your balance sheet if it is more likely than not that you will generate enough profit in the future to actually use the coupon.
You have to prove to the auditors that you'll be profitable.
Right. So when Vanda takes a valuation allowance, the accountants and the auditors are effectively saying, we have looked at the business model, we have looked at the internal forecasts, and we no longer believe it is probable that we will make enough profit to ever use these credits.
So it's a formal admission of failure.
It is a formal, audited admission by the finance team that future profitability is in serious doubt. They are writing off the asset because they don't think the profits are ever coming.
Wow.
It's a massive red flag.
Right.
It's the company literally betting against its own future earning power.
That clarifies the severity of it immensely. But I want to play devil's advocate here again, because you'll often hear management teams or sell-side analysts say, oh, ignore the GAAP numbers, ignore the non-cash tax write-offs, look at adjusted EBITDA, look at the core operating performance.
The favorite trick of unprofitable companies.
If we looked at that adjusted metric, would it look healthier?
This is where we have to be absolutely ruthless as analysts. We reject adjusted EBITDA at Synaptic Investing.
Completely.
We focus on truth. And the truth is free cash flow. EBITDA is an opinion, cash is a fact. And if you look at the operating cash flow for Vanda, it is deeply, deeply negative. We were talking about negative $109.4 million for fiscal year 2025.
So over $100 million in actual cash flew out the door.
Gone, never coming back. And here is the trap. You mentioned adjusted metrics. One of the biggest adjustments these companies make is adding back stock-based compensation, or SBC.
They love doing that.
They pay their executives and employees in stock options and then say to investors, well, that wasn't a cash expense today, so let's add it back to make our profit look better.
But that is pure accounting fiction.
It dilutes you, the shareholder. It is a real expense, it just happens to be paid in your ownership percentage rather than cash. If you strip away the SBT manipulation and just look at the cash burn, the company is structurally unprofitable.
They are not printing money. They are burning the furniture to keep the house warm.
That's the SBC trap. It inflates the metrics that management bonuses are tied to, but it hurts the long-term shareholder. Let's look at the free cash flow conversion ratio.
Well, it's negative. A healthy company converts net income to cash at a high rate. Vanda consumes cash to generate accounting losses. It's the exact inverse of what we want to see.
So we have a company losing massive amounts of money, but they have money in the bank to lose.
Yeah,
right. That's whole thesis for the bulls.
Right. This brings us to capital allocation and ROIC, return on invested capital.
This is the ultimate scorecard for the CEO. How good are they at investing the company's money?
We have a standard here on the show. The elite business standard is an ROIC of greater than 15%. Meaning, if you invest $1 into the business, you should get $1.15 back in value.
And Vanda's score on this metric?
Deeply negative. And this is crucial to understand for anyone listening. Vanda has a cost of capital. It costs them money to exist, to have equity, to take on risk. Let's say their cost of capital, their WACC, is around 8 or 10%.
Which is conservative for a small biopharma.
Very conservative. Their ROIC is negative. That means every single dollar management takes and invests in the business, whether into R&D or marketing a new drug, is technically worth less than $1 the moment they spend it.
They are destroying value mathematically.
Yes, you give them $1, they turn it into 80 cents.
This is the literal definition of a value destroyer.
But the counter-argument, the thing you always see on the message boards is, but look at the cash pile. They have so much cash.
They had so much cash. That's the trend we need to highlight. Static numbers are dangerous. Look at the velocity. The cash pile shrank from nearly $375 million to $263.8 million in just 1 year.
That is over $100 million gone. Poof.
Management is funding what they call organic growth, the R&D, the drug launches, with negative returns. They are taking a giant pile of gold and slowly turning it into lead, just hoping that eventually one of the lead bars miraculously turns back into gold.
That's a brutal visual, but it captures the dynamic perfectly. However, management would argue that we're looking in the rearview mirror.
Kind of ways to.
They would say, we are investing that cash today to build the future of tomorrow. So we have to look forward. The market is a forward-looking mechanism. We need to analyze the growth narratives versus the reality.
Let's do it. What is the bull case? Why would any rational person buy this stock today? Because management isn't just sitting on their hands in an empty office. They are launching new products.
Right. The bull case is all about the pipeline and the pivot. The argument is that the market is completely ignoring the new FDA approvals.
Because they have real approvals.
They do. They have Nurix, which is now approved for motion sickness. They have Basanti for bipolar and schizophrenia. And frankly, the bulls point to Fanapt. They say, look at that 24% revenue growth in 2025. The commercial team knows how to sell. If they can do that with an old drug, imagine what they can do with a brand new asset like Nurix.
Okay, so the bull case is basically the new drugs will work and the sales team is competent enough to push them.
That's the narrative.
But I have to push back hard on Nurix. I mean, motion sickness, is that really a blockbuster indication that's going to save a struggling pharma company?
That is the multi-million-dollar question. Let's deconstruct the total addressable market, the TAM, for these new drugs, because motion sickness sounds like a massive market on a pitch deck. Everyone gets seasick or car sick occasionally.
It sounds huge until you actually walk into a CVS or a Walgreens. What do you see on the shelf when you look for motion sickness?
You see Dramamine, you see Bonine, you see generic dimenhydrinate.
And they cost, what, maybe $5?
$5, maybe $8 for a big box that lasts you a year. This is the definition of a fully commoditized market.
The bear case asks a very simple but very difficult question for management to answer. Why would an insurer pay a premium, we are talking hundreds of dollars, for a prescription version of a drug when a $5 over-the-counter pill works perfectly well for 99% of the population?
Unless Nurix is essentially magic, unless it stops motion sickness in people where Dramamine fails completely, the payer pushback will be immense.
That's the Nurix problem in a nutshell. Insurers are not in the business of charity. They require step therapy.
Explain step therapy.
The insurer will say, okay, patient, you want Nurix. First, you must prove you failed on Dramamine. Then you must prove you failed on the scopolamine patch. Only then will we even consider paying for this expensive prescription.
And that friction kills sales volume. Doctors don't want to do the paperwork.
Exactly. It stalls the launch completely.
Right. And then you have to consider the base rates argument. High growth in biopharma, particularly for small caps launching into crowded spaces, is statistically very rare to maintain.
Most drug launches underperform expectations.
The market is currently betting that these new drugs, Nurix and Basanti, won't scale fast enough to stop the massive cash bleed we talked about earlier.
The bears are looking at that $100 million burn rate and saying, you aren't going to sell enough motion sickness pills to fill a $100 million hole in the boat.
It's a race. Revenue growth versus cash burn. And the burn has a massive head start.
A massive head start.
So we have a questionable business model, a shrinking pile of cash, and a very tough hill to climb for growth. This brings us to the core of the episode. The real reason value investors are looking at this stock. The valuation and the value trap thesis.
This is where it gets incredibly seductive for value guys. We have to acknowledge the net allure.
Let's look at the raw metrics as they stand today. The stock price is hovering around $6.10 per share. The market cap is roughly $360 million.
Okay, a $360 million price tag if you wanted to buy the whole company outright.
But they have cash on hand of roughly $264 million.
So if you bought the whole company for $360 million, you'd walk in on day one and immediately find $264 million in the bank vault.
Exactly. So your real cost, what we call the enterprise value, or EV, is only about $100 million.
Essentially, the market is valuing the entire operating business. The drugs currently selling, the patents, the scientists, the sales force, the future pipeline, at just $100 million.
It sounds absurd.
Isn't that a steal? I mean, surely the patents and the FDA approvals alone are worth more than $100 million to someone.
That is the exact logic that traps value investors. They say, I'm buying a dollar bill for 50 cents. But this is where we have to introduce a concept from Warren Buffett, the institutional imperative.
This is a crucial mental model. This is about human psychology, not spreadsheet math.
Correct. The institutional imperative basically says that management teams will do almost anything to keep the institution going, regardless of whether it makes economic sense for the shareholders.
They do not want to liquidate the company. A rational robotic actor might look at the math and say, hey, our stock is cheap, our core business is losing money rapidly, let's just close up shop, sell the IP for whatever we can get, give the $264 million in cash back to the shareholders as a special dividend, and I'll go home.
If they did that, you'd get a massive payout compared to that $100 million enterprise value. It would be a huge win.
But if they do that, the CEO loses his job, the CFO loses her job, the scientists lose their labs, the board loses their director fees.
Exactly. Human nature dictates they want to keep their jobs and their status. So the prediction based on the institutional imperative is that they will burn that $264 million cash pile to try to make the failing business work.
They will gamble the shareholders' sure thing the cash on a highly risky bet the new pipeline.
So if you buy now because of the perceived safety of that cash floor, you are ignoring the fact that the floor is an elevator and it's going down fast.
It's a sinking floor. We did the math earlier. They burned over $100 million last year. So in 12 months, that $264 million cash pile could be $150 million. In 2 years, it could be $50 million.
If you buy at $6.10 thinking the cash protects your downside, you are wrong. The cash is currently being used as fuel for a fire that isn't keeping the house warm.
Let's try to triangulate the intrinsic value then. If we can't trust the cash floor to hold, what is this thing actually worth? Because usually, we'd look at earnings power.
We tried 3 standard methods to value this. Method A is historical earnings. It's impossible. Earnings are negative. You can't put a PE ratio on a persistent loss.
There is no historical earnings support. Strike one.
Method B is owner earnings. That's usually our favorite metric on this channel.
Look at the cash generation.
But again, free cash flow is negative $110 million. The operating business is a financial liability right now, not an asset, based on current cash flow.
So owner earnings is a negative number. Strike two.
So we are left with method C, the net cash floor. We take the $263.8 million in cash, and we divide it by the 59 million shares outstanding.
That gives us a value of roughly $4.47 per share in pure cash value.
$4.47, and the stock is trading at $6.10.
So the stock is trading above its cash floor. There is no margin of safety here.
None at all. You are paying a premium over the cash. You are paying $1.60 per share for the privilege of owning an operating business that is losing $100 million a year.
When you lay it out like that, it sounds insane to buy it here. So, is there a buy zone? Is there a price where this actually becomes a cigar butt worth picking up?
For us, looking at the math, the only price at which this becomes interesting, and I stress interesting, not necessarily good, is between $3.50 and $4.50.
So you have to buy it below the cash value.
Yes. You need to buy it at a discount to the cash. You need to buy it such that you are effectively getting the cash at a discount, and you are getting the entire pipeline, Nurix, Basanti, Fanapt, for free.
Or even better, had a negative enterprise value.
Exactly. At $3.50, you are buying the cash at a discount and getting the lottery ticket of the drugs for zero risk. But at $6.10, you are paying for future execution that hasn't happened yet. And given this management team's history of value destruction, paying for their future execution is a very dangerous game.
That's a very clear line in the sand. $3.50 to $4.50, Anything above that, you're betting on a miracle turnaround in efficiency.
Correct.
This leads us to our final assessment. We always like to perform a premortem on these deep dives. Let's assume it's 2028 and Vanda's stock has gone to zero. What happened? How do we lose 100% of our capital here?
The premortem is vital for checking our blind spots. In this case, the path to zero is frighteningly clear. Step 1 is capital dependence.
Meaning they rely on outside money.
Vanda is burning cash rapidly. If they don't reach free cash flow break-even before that piggy bank runs out, they must issue equity. They have to sell new shares to the public to raise money to keep the lights on.
But if the stock price is low because the business is struggling, selling shares dilutes the existing shareholders into oblivion.
That is the reflexive death spiral.
It's vicious.
The lower the stock goes, the more shares they have to print and sell to raise the exact same amount of money, which drives the stock price even lower, which means they have to sell even more shares next time. It completely wipes out the early equity holders.
That's scenario 1. Dilution to death. What else?
Scenario 2 is commercial obsolescence. This is the specific risk with Nurix. Insurers simply refuse to cover it. They say, just use Dramamine, we aren't paying for this.
If that happens, the entire R&D investment for that drug is stranded.
It's money set on fire with zero return. It accelerates the cash burn.
And scenario 3.
Generic acceleration. The Hetlios revenue evaporates even faster than the new drugs can replace it.
Yeah.
The hole in the bucket gets bigger while the hose filling it gets smaller. That leads right back to the cash crunch and the death spiral we just talked about.
It's a trifecta of risks. So let's bring it all home. The final synthesis. What is the quality score for Vanda?
Quality score is low W. It fails almost every single synaptic filter we have. ROIC is less than 15%. Free cash flow conversion is less than 80%. In fact, it's deeply negative. And there is no durable moat because the patents are expiring.
And the valuation score.
I'd rate the valuation as fair. Expectations are undeniably low. The market isn't pricing in a miracle here, but the price isn't distressed enough to be a classic, safe cigar butt play yet. It's sitting in no man's land.
If you had to give a 5 to 10-year outlook for the company.
It's a bimodal outcome. There is really no middle ground of steady 5% growth here. Either they defy the odds, prove the base rates wrong, commercialize these new drugs incredibly successfully, and become a profitable mid-cap.
Which is possible, but improbable.
Or they follow the S-curve graveyard of mid-cap biopharma.
Which looks like what?
Perpetual cash burn leading to a distress sale where they get bought out by big pharma for pennies on the dollar, or heavy equity dilution that wipes us out entirely.
It's a binary bet. And as investors, we generally prefer asymmetrical bets, where the upside is high and the downside is firmly capped. Here, the downside seems pretty open until you hit that 350 floor.
Exactly.
So we've unpacked the business model, the real numbers, the value trap dynamics, and the valuation. It's a very complex picture.
It is. And that brings us to our final thought for the day.
The takeaway.
The market is a weighing machine in the long run. Right now, it's weighing Vanda's cash stack against its massive burn rate. If you're buying this stock at current prices, you aren't investing in a compounder. You're betting that a management team that has destroyed capital historically will suddenly learn how to multiply it. Ask yourself, is that really a bet you want to make with your hard-earned capital?
A powerful question to end on.
Thanks for watching Synaptic Investing. We'll see you in the next deep dive.